Most traders who lose money on NQ are not losing because their strategy is bad. They are losing because they do not understand what the market is actually doing before their setup appears. They are entering trades without knowing where the market wants to go first. And that one missing piece is what causes the stop hunts, the fake breakouts, the trades that look perfect and then immediately go against you. What I am going to show you in this video is the framework I use every single day to understand where liquidity sits on NQ, how the market moves to grab it, and how I position my trades around that. 3 parts. Straightforward. Let me get into it. This is not a beginner video on what a stop loss is. I am assuming you already understand basic market structure and price action. What I want to show you is how liquidity connects all of that together and why understanding it specifically on NQ changes how you read every session. We are going to cover 3 things. First, what liquidity actually is and why NQ behaves the way it does. Second, where I find liquidity levels before the session starts. And third, the exact way I trade around those levels to get funded and stay funded. So, what is liquidity? In simple terms, liquidity is where other traders have placed their stop loss orders. Every time a trader enters a position, they put a stop somewhere. Most of the time, that stop sits just above a recent high or just below a recent low. And when enough stops are sitting in that same area, that area becomes a liquidity pool. Think about it like this. You have a swing high on NQ. Every trader who went short near that high has their stop just above it. Every trader who is waiting for a breakout has their buy order just above it. So above that swing high, there is a cluster of orders sitting there waiting to be triggered. The market does not move randomly. It moves toward these clusters because triggering those orders creates the volume and momentum needed for the next real move. This is not a conspiracy. This is just how markets work at a mechanical level. NQ is particularly aggressive about this because it is one of the most liquid and actively traded futures contracts in the world. Institutions, algorithms, and large players are all operating in the same space, and they need liquidity to fill their positions. So the hunt for stops is not occasional on NQ. It is basically constant. Once you start seeing it, you cannot unsee it. The second part is where I actually find liquidity before I trade, and the answer is in the sessions. Every trading day on NQ creates a specific map of liquidity. Asia session runs roughly from 6 p.m. to 2 a.m. Eastern New York time. It tends to be the quietest session. It creates a range, an Asia high and an Asia low. Those 2 levels almost always matter later in the day. London opens at 3 a.m. New York time. This is where the first major liquidity raid usually happens. London will frequently come in and take out the Asia high or the Asia low. That raid, that stop hunt, is often the setup for the rest of the day. New York opens at 9:30 a.m. This is where the real move usually happens, and the direction of that move is usually telegraphed by what London did. If London took the Asia low, New York often pushes higher. If London took the Asia high, New York often pushes lower. So before I trade any sessions, I have these levels marked. Previous day high, previous day low, Asia high, Asia low, opening range high and low once New York opens. These are not random lines. They are where liquidity sits. They are where stops are clustered. And they are where the market is most likely to go before it makes its real move. The question I am always asking is simple. Is there more liquidity above price or below price right now? If there are equal highs sitting above me, if there is an untapped Asia high, if the previous day high has not been touched, that is liquidity above. The market is likely to reach for it before going lower, and I trade with that in mind. The third part is how I actually trade this, and I have simplified it down to 3 steps that I go through on every single trade. Step 1. Identify where the liquidity is. Using the levels I just described, sessions highs and lows, previous day levels, I decide before the session whether the likely target is above or below current price. That gives me my directional bias for the day. Step number 2, wait for the sweep. I do not trade into liquidity. I trade after it has been taken. So if there is liquidity above price, I wait for the market to push up, take those highs, trigger those stops, and then I look for the reversal. The sweep itself is not my entry. The confirmation after the sweep is my entry. Step 3. Enter on the fair value gap after the sweep. Once the liquidity has been taken and price starts to reverse, I look for a fair value gap in the direction of the new move. That fair value gap is my entry point. Stop goes above or below the sweep candle depending on direction. Target is the next liquidity level on the other side. This is what it looks like visually. You have your liquidity level. Price pushes through it, triggers the stops, creates a sharp candle. That candle leaves a fair value gap. Price pulls back into that gap. That is the entry. The whole sequence from sweep to entry often takes just a few minutes on NQ. You have to be ready for it. Here is a real example of how this plays out. Asia creates a high. London comes in during the early hours and takes that high. A clean sweep above it. Price reverses. On the 1 minute chart, you can see the fair value gap left by the sweep candle. Price retraces into that gap. Entry there. Stop above the sweep. Target is the Asia low on the other side or the previous day low depending on how extended the move is. That is the trade. Clean, structured, and based entirely on where the liquidity was sitting before the session started. So, to bring all of this together, liquidity is where stops are sitting. On NQ, it is constantly being targeted. Your job is not to predict where price goes randomly. Your job is to understand where the stops are, wait for the market to go get them, and then trade the move that follows. Mark your levels the night before. Asia high and Asia low. Previous day high and low. Come in with a bias. Is the liquidity above or below? Wait for the sweep. Enter on the fair value gap after the confirmation. Manage your trade to the next liquidity target. That is the complete framework. It is not complicated, but it takes time to see it consistently. The more sessions you watch with this framework in mind, the more it starts to look obvious. And once it is obvious, your decisions get a lot cleaner. If you are struggling with NQ right now, I would bet that most of your losses are coming from entering before the sweep happens. You are taking the trade too early. You are getting in before the stop hunt, and then the stop hunt takes you out. Start watching for the sweep first. Be patient with it. Let the market show you where the liquidity is before you commit to a direction. If you want to work through this framework properly with real-time examples and live trading sessions, I have a mentorship called the Pro from Blueprint where I trade CFD and futures live every day with my students. We go through exactly this, the levels, the bias, the entry. Link is in the description if you want to apply. And if you need a pro firm to trade with, I use and recommend Hola Prime. Fastest payouts in the industry, awarded at the Dubai Expo, under an hour for payouts, zero payout denial policy. Code NFX gets you the best discount available. Link is in the description. See you in the next one.